Welcome back to the Deep Dive. Today, we are putting aside the spreadsheets, the earnings reports, all the balance sheets, to focus entirely on the messy, chaotic, and, well, the utterly human side of finance, emotion. I mean, if you've been navigating the market volatility of late 2025, and of course the dramatic swings that have already kicked off 2026, you know that fear and greed aren't just abstract concepts.
No, not at all. They are tangible, quantifiable market forces. They really dictate where trillions of dollars flow.
Exactly. And that's what we're getting into today.
It is. Our source material today is really compelling us to move past that simple daily headline number of the fear and greed index, the F&G as people call it.
Right.
We need to truly understand its detailed mechanics, because if you see that number flashing extreme fear, you need to know what ingredients actually went into that composite score.
What does that mean?
Precisely.
Yeah.
So our mission today is to explore how this index is constructed, how it applies differently, and uses different signals across asset classes.
Yeah.
Think traditional stocks versus hypervolatile crypto.
Two totally different worlds.
Totally. And most importantly, we're going to look at the major historical and recent events right up to this moment, January 2, 2026, where collective sentiment has just demonstrably dominated price action.
I think at the end of the day, understanding the crowd's mood is the first and maybe the most difficult step toward avoiding that herd mentality.
It's the whole ball game.
I love that framing. We're really aiming for the shortcut to being well-informed here, making sure that the next time you see a market crash or some irrational surge, you immediately recognize the psychological state that's driving it.
Let's start with the foundational tool then. The index, which was popularized by CNN Money, is essentially an emotional barometer. Its core function is just to measure investor sentiment to gauge the overall market conditions really, really quickly.
And the beauty of it, I think, lies in its foundational behavioral principle. Extremes rarely last. It operates on this idea that when fear is excessive, the selling pressure is probably unsustainable. It's driving prices down below their intrinsic value.
And on the flip side, when greed is excessive, the buying pressure is often irrational, creating potential bubbles.
Classic bubble.
That's the core thesis. It converts this incredibly complex emotional spectrum into a standardized numerical score. It ranges from 0, which is always defined as extreme fear, up to 100, which is extreme greed. It gives investors a quantitative, fast snapshot that just cuts through the noise of the daily news.
And for anyone who wants to use this as a supplementary indicator, and we have to stress supplementary understanding the actionable thresholds is just critical.
Absolutely.
Our sources consistently highlight that writings below 25 often suggest that, well, full-blown panic selling has taken hold.
Right.
For long-term, patient, or maybe contrarian investors, that 25 level, or really anything lower, might start flashing as a potential buy signal.
And conversely, if the index score is above 75, that typically marks a period of excessive optimism. Sometimes it's just boiling over into euphoria.
Everyone thinks they're a genius.
Exactly. It's a point where prices may be discounting every possible piece of good news and assuming zero future risk. So that high reading should prompt caution. It's a potential signal to maybe reduce exposure, take some profits, or at the very least, tighten those stop losses you have in place.
But stepping back, I think this is where the deep dive aspect really kicks in. How do you actually mix these, disparate technical signals, things like the number of people buying put options versus how high the stock market is trading relative to its moving average?
It feels like combining apples and oranges.
It does. How do you get one coherent, singular number out of that?
That's precisely the challenge and, frankly, the genius of the robust F&G model methodologies. It's not just a simple average, it's a very careful construction. The index combines multiple, completely unrelated market inputs. The CNN version, for instance, uses 7 distinct ones.
So the secret sauce is the math, the standardization, right? That crucial process here is called normalization, specifically using a min-max scaling technique. This is what forces those apples and oranges to speak the same emotional language.
Exactly right. Imagine one input is the VIX, which might range from, say, 10 to 80 on a given day. Another input might be the spread between two different types of bonds, which might range from 50 basis points to 500.
Vastly different scales.
Completely. If you simply average their raw scores, a big move in the VIX would just drown out the signal from the credit market entirely, no matter how terrified the bond market was feeling.
So normalization solves that problem. Each indicator's raw data point, or its percentage change, is scaled using this mathematical technique, ensuring that every input fits perfectly and, more importantly, equally within that structured 0 to 100 fear and greed range.
And here's a technical detail that really matters. You have to set the historical boundaries. So any value that falls below the predefined historical minimum for that indicator, let's say the lowest the VIX has ever been recorded during a period of extreme complacency, is mathematically clipped to zero.
Okay, so that's its floor.
That's its floor. It signifies the maximum possible level of fear or minimum complacency derived just from that one input.
And I'm guessing the same is true on the other end.
And vice versa. If an indicator spikes beyond its historical maximum, say, the highest level of call buying ever recorded, it is clipped to 100, signifying maximum greed. This careful, structured process is essential because it guarantees that a single extreme move in any of the 7 inputs carries equal weight in the final score.
Which prevents one really volatile input from just skewing the entire result.
It's a critical technical detail, and it reinforces something vital for you to remember. Since there is no single official formula, mandated by some global governing body, different sites will publish their own versions. And they might use slightly different indicators or different weighting schemes or even different look-back periods for their historical max and min values.
Which means we need to be discerning. We can't just rely on a single, maybe proprietary index and assume it speaks for the whole market.
You can't.
An index published on a major finance site today might be signaling 78, which is extreme greed, while a competing index using slightly different inputs might only be showing 65, just regular greed.
A very different signal.
A very different signal. So investors absolutely need to check multiple trusted dashboards to get a more rounded perspective on the prevailing mood.
It's the ultimate reflection of what we call attitudinal research. It's designed to capture the emotions driving market behavior, but if the ingredients or the scaling parameters change, well, the final number changes too. You have to be aware of the recipe.
Okay, so shifting gears a bit, let's drill down into the specific quantitative and behavioral ingredients that actually build these fear gauges. We're moving beyond the score itself to the inputs that really give it context.
Let's do it. Focusing first on traditional finance, particularly the metrics used in indices that track U.S. equities. These pull from classic indicators of market stress and institutional activity. The first component is the put-call ratio.
This tracks options activity. So when investors anticipate turbulence or they just want some protection, they buy put options, which are essentially insurance policies against a price drop. So high put volume suggests fear, or at least hedging. Conversely, when investors are buying calls, they're speculating on a rapid upside movement. That signals greed.
Exactly. The ratio usually moves inversely to confidence. If there's an abnormally high number of puts being traded relative to calls, the ratio spikes, and that flashes fear.
Makes sense.
Then you have the most direct measure of anxiety in the financial world. Market volatility, or the VIX. It's literally known as the fear gauge.
The VIX measures the market's expectation of future volatility, and it's derived from S&P 500 option prices. So higher VIX levels mean that investors expect large, rapid price swings, which just equates to high fear and uncertainty.
And lower VIX levels, especially persistently low ones, suggest deep complacency. Investors feel comfortable and therefore, well, greedy.
Right, there's no fear of a downturn.
We also look at credit markets, which are often the first place institutional stress appears. We do that through junk bond demand. Junk bonds, or high-yield bonds, are issued by riskier companies. So when investors are greedy and highly comfortable taking on risk, they pile into these bonds, and this demand narrows the spread, or the difference in yield, between junk bonds and safer investments like Treasuries.
I see. So when people are demanding only a tiny bit more yield to hold risky corporate debt versus holding the absolutely safest U.S. government debt, that means they feel very little risk of default. It's a sign of pure greed.
That's it. And a widening spread where investors demand a much higher premium to hold that riskier debt indicates severe systemic fear.
And the last one.
And finally, there's safe haven demand. This metric specifically compares the relative returns and demand for stocks versus U.S. Treasury bonds. So if we see a widespread, dramatic shift of capital flocking into U.S. Treasury bonds, the safest asset, that indicates widespread fear in the market.
And a strong, sustained preference for stocks, the risk assets, naturally reflects greed. These four, along with a few others, they paint a really comprehensive, institutionally driven picture of the U.S. equity mood. But this scaling concept, it must be applicable globally. How does that translate when we look at, say, the Indonesian stock market?
It's a fantastic case study in adaptation. If we look at the methodology for sentiment gauges in the Indonesian stock market composite, the IDX, they need similar but locally specific data points.
Why is that?
Because the credit and derivatives markets function differently, or sometimes the data just isn't as readily available. So they require direct indicators of local stock market sentiment, not just generalized U.S. flow data.
So instead of a global VIX, they're using local volatility.
Yeah.
Their required data points would include local metrics, like market momentum, measured by the daily stock price changes for the IDX composite.
And stock price strength, which is derived from the daily closing prices of individual stocks within that composite index.
Okay, that makes sense.
Precisely. They track volatility based on the daily closing prices of the IDX composite itself, along with volume breadth, using daily trading volume data. This shows whether participation is broad or narrow, which is a key sign of sentiment health.
Right. Are a few stocks carrying the whole market, or is everyone moving together?
Exactly. And crucially, their safe haven demand calculation specifically uses the 10-year Indonesian government bond daily rate and compares it directly to the Indonesian stock market capitalization.
That adaptability really proves the power of the methodology. It's a process of normalization and scaling that matters, not the exact asset you choose to measure.
That's the key.
Now, let's pivot to crypto, because the Bitcoin F&G index is an entirely different creation. I mean, it focuses so heavily on high-frequency, sometimes just purely emotional signals designed to capture rapid retail psychology shifts.
Yeah, rather than relying on the slower institutional flow indicators we just discussed.
Yes.
The crypto market operates 24/7, it has no central governing authority, and the underlying assets are just exponentially more volatile. So the inputs have to react faster. First, the core volatility input measures 30 and 90-day price swings. The index moves incredibly quickly because a major headline, say, a regulatory threat or a big exchange security problem, can rapidly widen those price swings in minutes.
We also see inputs like market momentum and volume, which track spot and derivatives turnover. In crypto, retail trading really dominates the sentiment swings.
It does.
Buying or selling by individual traders can change so suddenly and significantly in response to perceived threats or opportunities, making volume a really powerful short-term fear indicator.
And this is where the behavioral inputs become absolutely critical. Traditional finance relies on, regulated options volume. Crypto relies on the court of public opinion.
The Wild West.
It is. Social media sentiment analyzes posts across platforms like X, formerly Twitter, Reddit, and Telegram. These analyses look for shifts in tone and volume, and sentiment on these platforms can spike within minutes of new information, good or bad, making it a real-time fear indicator, often preceding price moves.
Then there is Bitcoin dominance. This one is interesting. It tracks Bitcoin's share of the total crypto market cap. So when money starts flowing out of the most secure asset, Bitcoin, and into smaller, riskier altcoins, often called shitcoins by people in the space, it signals higher risk-taking and speculation.
It's classic greed behavior among speculators. That shift in allocation is a huge tell.
Definitely.
We also track the curiosity of the general public through Google Trends. Search interest in emotional terms like buy Bitcoin, or on the other side, crypto crash, jumps suddenly when the topic goes viral among everyday investors, not just the professionals.
So it's a powerful barometer of the retail entry or exit points, the non-professional crowd rushing in or rushing out.
Exactly. And finally, we have the proprietary data sources used in various index versions. These can include metrics like market composition, measuring the relative value of Bitcoin versus major stablecoins.
A shift from stablecoins back into crypto suggests confidence.
Right. And it can also include internal proprietary data that tracks specific keyword searches and user engagement metrics on centralized exchange platforms. It's an index that's just designed for speed and for retail panic.
Okay, so to complete the picture of sentiment analysis, we have to differentiate between opinion and action, especially when we're trying to measure sophisticated capital.
A huge distinction. This leads us to look at metrics that track both the generalized mindset and the actual capital deployment of sophisticated players.
So we start with opinion. The AAII Investor Survey that tracks expectations and opinions. This survey tracks the weekly percentage breakdown of retail investor sentiment. It splits them into bullish, neutral, and bearish camps.
It's pure attitudinal research, what people say they feel. And historically, the average breakdown shows market sentiment is surprisingly bullish biased. Bullish sits around 37.5%, neutral is 31.5%, and bearish is 31.0%. But professional traders often use this survey as a classic contrarian indicator.
How so?
Well, if retail bullishness hits extreme highs, say, 60% bullish professionals often see this as a warning that the market is running out of new buyers. It signals a potential market top precisely because the unsophisticated money is already fully committed.
I find that contrast fascinating. The AAII is a great measure of the collective heartbeat of the retail crowd, but is it predictive or is it just symptomatic?
It's symptomatic. Now, contrast that sharply with the NAAIM Exposure Index. This is arguably one of the most reliable measures of institutional sentiment
Okay.
because it quantifies how professional money managers, members of the National Association of Active Investment Managers, are actually positioning their portfolios in terms of net equity exposure to the U.S. stock market.
So if AAII measures what people say, the NAAM measures what they do with their clients' money.
Exactly. It measures real-world capital deployment. Readings above 100% indicate strong institutional bullishness. These managers are aggressively long, sometimes even leveraged, in equities. They're acting on their conviction.
And on the other hand,
On the other hand, readings below 30% reflect peak fear or extreme risk aversion, where professional managers have drastically cut their equity exposure, preferring cash or high-quality bonds instead.
so if I see the NAAM index plummeting into the single digits, that means the people who manage billions of dollars have actually moved the money out. That feels like a much more reliable indicator of true institutional fear than some online survey.
It is, because institutional decisions affect liquidity and market depth. When you analyze sentiment, you really need both sides. What the public says they feel with AAII and what the large funds do with their money with NAII. The disparity or the alignment between those two tells a much richer story than just the headline F&G number.
Right, it's the context.
This deep dive into the inputs leads us directly to the practical application, which raises a really important question. How do we actually apply these gauges in real time? The core wisdom is simple, as we've noted, but the execution is notoriously difficult, especially when you're just immersed in the daily market chaos.
It all comes down to the wisdom of the Oracle of Omaha, Warren Buffett. We have to start with that foundational doctrine. Be fearful when others are greedy, and greedy when others are fearful. The F&G index gives us a numerical, non-judgmental reference point for identifying those emotional extremes.
To be fearful when others are greedy means recognizing that when the index is flashing extremely high numbers, say consistently above 80 or even 90 asset prices, are likely overvalued due to irrational, widespread optimism.
Everyone who wanted to buy has already bought.
Pretty much. And prices reflect this future perfection that, well, it rarely materializes.
We saw a textbook example in the crypto market. On November 9, 2021, the crypto index hit 84, near peak greed, fueled by this euphoria about NFTs and altcoins. That reading immediately preceded Bitcoin rolling over and entering a months-long slide. That level of collective greed often precedes short-term Bitcoin tops, creating a terrible entry point for new capital.
And conversely, to be greedy when others are fearful means looking for opportunities when fear reaches those deep, extreme levels, like below 25 or even into the single digits.
Yeah.
In these moments, markets often overreact to bad news, pushing prices lower than is justified by the underlying fundamentals. This is historically a potential buy signal, but it requires iron discipline acting against the screaming prevailing sentiment.
That discipline is the entire challenge. I mean, it's easy to read Buffett's quote and nod along, but the minute your portfolio is down 40% and every news channel is using the word crash, acting greedy feels impossible.
It does. But we can trace this principle through recent market history. Let's look at the stock market during the depths of the pandemic panic in 2020.
Right. During the March 2020 COVID-19 crash, the Fear and Greed Index hit 12. That's extreme fear, its lowest reading in years up to that point. The sheer psychological terror of the unknown, a global shutdown, was fully captured by that reading.
Yet only 3 trading days later, U.S. equities began a multi-month, really dramatic advance. This perfectly illustrates how intense panic selling can quickly exhaust itself.
So once the last person who needs to sell because of panic or margin call or just pure fear has sold,
then the market is often cleared of weak hands, turning that fear into a fantastic, albeit terrifying, entry point for patient capital.
we saw an even more profound, though maybe shorter-lived panic much more recently. This was related to geopolitical tensions. On April 8, 2025, the CNN F&G index hit 3, a reading of 3.
Yeah, that's a reading that genuinely rivaled the systemic panic we saw in March 2020. That level of extreme risk aversion was just stunning.
And what happened?
And despite that grim single-digit reading, the S&P 500 bounced roughly 3% within a single week. This suggests that a very low reading often marks a short-term market low because the panic has become so pervasive that everyone is already positioned defensively.
There's no one left to sell.
There's no one left to sell. The simple fact is that there is usually more risk in the single digits, which is peak fear, than there is in the high 90s, peak greed.
However, the crypto market provides a vital reality check here.
Oh.
Panic doesn't always just dissipate in 3 days. When
Yeah.
you think about the FTX collapse in late 2022.
Ooh, yeah. That event, which threatened the entire ecosystem's trust, pushed the index down to a historical low of 6.
6.
That event drove fear not just because of price movement, but because of counterparty risk and, well, systemic fraud. The key lesson here is that extreme fear can persist for a prolonged period. That market lingered at the bottom for more than 90 days.
So if you acted on that index reading of 6, you had to endure 3 months of dead money, watching the market do absolutely nothing before the true recovery even began. That's the painful side of contrarian investing. It's one thing to see the data point that buying at the bottom is historically profitable. It's another thing entirely to wait 90 days, sitting on large losses, wondering if this time is different, if the whole asset class is fundamentally broken.
But the historical data overrides the feeling. Across all historical cases, buying at that extreme fear level and holding for 180 days, 6 months, resulted in significant positive returns almost without exception.
Wow.
The data is absolutely clear on this. Selling when the panic index falls into the single digits has historically been the wrong decision. The accumulation phase, though emotionally painful and requiring immense patience, offers the best risk-reward ratio for patient capital.
Okay, here's where it gets really interesting. How did these sentiment gauges react during major systemic shocks where fear truly just cascaded across global markets? We have some fascinating data points from crises stretching from 2015 to 2025 that show how quickly the mood can shift.
Let's start with the turbulence centered around the 2015 Chinese stock sell-off. This was a pivotal moment because it demonstrated the new global interconnectedness of fear.
Right.
The precursors were actually visible in the U.S. markets days earlier, showing that initial fear ripple effect.
Between August 18 and August 20, 2015, the Dow Jones Industrial Average fell substantially, and it culminated in this steep sell-off on Friday, August 21, when the DJIA fell 531 points, or 3.12%. It wiped out 1,300 points over just 3 trading days.
And that Friday sell-off was just the warning shot.
Yeah.
When global markets reopened the following Monday, August 24, 2015, the fear just cascaded globally. It led to what Chinese state media officially termed Black Monday. World stock markets were substantially down, erasing all the gains they had made throughout 2015.
It was a massive global capital event.
It was. An estimated $10 trillion had been wiped off global markets since June 3, driven by panic selling and margin calls. China's 8% drop was the headline, but the sentiment was universal.
The contagion was felt everywhere. In India, the Sensex recorded its biggest single-day fall of over 1,600 points, ending the day down nearly 6%.
Yeah.
European markets dropped at least 3%. The FTSE lost 4.4%.
And amid this turbulence, demonstrating the extreme governmental fear, the People's Bank of China intervened. They devalued the RMB twice in August 2015, a desperate move designed to make China's exports more competitive and offset the domestic economic slowdown.
But here's the critical sentiment lesson. The rebound was swift. It illustrates how quickly that short-term, generalized fear can exhaust itself. Just 2 days later, on August 26, U.S. markets rallied hard. The DJIA, NASDAQ, S&P 500 all registered gains of about 4%. For the DJIA, this was the third largest point gain on record at the time.
The market essentially said the fear was overdone.
Pretty much.
Yeah.
Now, moving to 2016, we saw the Brexit crash, which was a systemic event driven almost purely by a political sentiment shock. The fear was built up over months, causing significant polling shifts that saw the FTSE 100 fall 2% on June 14, only to recover on June 20 as sentiment briefly leaned back toward Remain.
The shock came on June 24, 2016, when the Leave vote won. Global stock market crashes just ensued. The initial psychological reaction was a complete lack of faith in the future, resulting in investors losing the equivalent of over $2 trillion that single day, the worst single-day loss in history at that time, with total losses reaching $3 trillion by June 27.
The immediate market reaction was just a severe flight to safety. The fear index would have spiked instantly as capital rushed out of risk assets.
Oh, for sure. Traditional safe haven assets surged dramatically, including gold and the Japanese yen. The Swiss National Bank actually had to intervene to cap the rise of the Swiss franc.
A clear sign of systemic panic.
A clear sign. It's money being forced into perceived safety.
Yet, true to the historical pattern, the recovery was fast once that initial shock wore off and market participants realized the economic implications would take years to unfold.
Right. By June 29, markets had largely stabilized, and by July 12, the Dow and S&P were closing at new record highs. Sentiment drove the crash, fundamentals quickly moderated the fear and drove the recovery.
Now let's talk about a far more sudden, purely technical systemic shock that occurred much more recently. The 2024 carry trade unwind. This was less about general economic fear and more about highly leveraged technical models just breaking down under unexpected volatility.
The shock was immense on August 5, 2024. Global markets were shaken by a sudden, violent spike in volatility. Japan's 2px and Nikkei 225 indexes plummeted more than 12% in a single day, their steepest drop since 1987.
Wow.
The S&P 500 fell as sharp, though comparatively moderate, 3% on the same day.
The VIX response tells the true story of the underlying fear, though. Our fear index saw an extreme and just outsized response. It jumped over 40 points to 65 in early trading, hitting levels not seen since the onset of the COVID-19 pandemic.
That intraday max for VIX on August 5 was an enormous jump relative to the S&P 500 returns. It reflected the massive stress in derivatives and hedging markets.
So what was the core of the problem? Why did the fear amplify so quickly?
The yen carry trade. This highly leveraged strategy relies on borrowing in a low-yielding currency, the yen, to invest in higher-yielding assets elsewhere. It's a common trade during periods of low volatility.
They call it picking up nickels in front of a steamroller, right?
That's the one. It generates consistent small returns when calm prevails, but you incur steep, instant losses when turbulence erupts.
And when turbulence hits, those leveraged players are forced to unwind their bets instantly to cover margin calls. This massive forced selling turns a bad day into a cascade of fear.
Reinforcing the volatility that caused the initial problem, it's a perfect feedback loop where leveraged positioning amplifies sentiment.
And the sheer size of the exposure must have guaranteed maximum amplification.
Oh, it did. Yen-denominated loans to non-banks residing outside Japan had risen markedly post-COVID-19 to about $40 trillion, or roughly $250 billion, by March 2024.
And that's just one part of it.
Right. If you include cross-border yen bank claims on non-banks, that figure exceeded $80 trillion, so approximately $500 billion.
That's $500 billion in leveraged bets, all potentially forced to unwind simultaneously by one volatility spike. This massive scale, triggered by a volatility shock, turned an initial technical event into a systemic crisis event. The F&G index wasn't just measuring fear, it was measuring the panic-driven deleveraging of $500 billion.
If we connect this to the bigger picture, the present, as of early 2026, what do the dynamics of the last year tell us about how sentiment is influencing the market today? We have witnessed a remarkable whipsaw story in 2025 alone, driven by AI enthusiasm, Fed policy shifts, and political shocks.
The 2025 stock market was a textbook example of sentiment driving price. It started with that massive April panic low where the CNN F&G index hit 3 extreme fear, coinciding with a stock drawdown related to that tariff tantrum we mentioned earlier. That bottom really set the stage.
That intense, short-lived panic was immediately followed by a relentless surge into what we'd call summer greed. Sentiment rapidly surged through the summer of 2025, signaling extreme greed by July and August as markets powered ahead.
And the excitement was driven by 2 key factors, right? Exponential enthusiasm over AI-related companies and these widespread hopes for aggressive Fed easing. The easy money outlook was back.
The momentum was astounding. This push drove the major indexes to historic heights. On August 28, the S&P 500 closed at a new all-time high of 6,501.86, and the Nasdaq Composite finished at 21,705.16.
But that surge was highly concentrated. It was AI-related companies providing the primary power source for those gains, which demonstrates a narrow but very intense greed.
But the mood flipped hard almost instantly in October. By mid-October 2025, the index was back into the low 30s, officially fear territory. It was a dramatic reversal from the summer euphoria.
And this turn was sparked by a specific geopolitical event. New China tariffs announced by the Trump administration, which stunned investors and triggered a sharp sell-off. The S&P 500 and Nasdaq suffered their largest single-day percentage losses since early April.
That really illustrates how fragile a greed-driven market can be. It takes just one major external shock, in this case politics, to collapse the confidence that drove prices up.
However, the year didn't end in fear. We saw an end-of-year rally take hold, the classic Santa Claus rally phenomenon. The S&P 500 continued to hover just under its all-time highs as 2026 began. Looking ahead, 7,000 remains a key psychological target for the markets to trade toward in early 2026, suggesting underlying confidence is still resilient.
The crypto market naturally experienced even more extreme swings in 2025, but with a foundational shift: maturing institutional involvement.
A huge shift.
Bitcoin saw a massive rally, surging to $123,000 in July 2025, which saw the total crypto market capitalization peak at $4.3 trillion before retreating to around $3.05 trillion by the end of the year.
That $123,000 figure is staggering. But despite the high prices, the underlying Bitcoin fear and greed index crashed to 10 extreme fear. It was its lowest level since the 2020 COVID meltdown.
It shows that volatility and major price swings are still deeply embedded and that retail psychology remains incredibly fragile.
And here's the huge geopolitical overlay. 2025 marked the institutional pivot. In early 2025, President Trump signed an executive order establishing a strategic Bitcoin reserve, the SBR, and a U.S. digital assets stockpile, funded entirely by seized crypto assets.
This is critical because sales from the SBR are prohibited. It's intended as a long-term store of national assets. That signals long-term official governmental acceptance of the asset class.
Yet even with that official endorsement, we saw signs of institutional hesitancy, which resulted in some significant institutional selling. On-chain data revealed that whales wallets holding 10 to 10,000 BTC sold about 32,500 Bitcoins since mid-October 2025.
And most notably, BlackRock, the world's largest asset manager, executed a major, sudden sell-off. They sold approximately $101.4 million of Bitcoin and $22.1 million of Ethereum. This wasn't panic selling. This was sophisticated strategic deployment or risk management.
Right. It raises questions about internal strategies and the role of institutional capital in mediating that retail sentiment.
Analyzing the 2026 outlook from a technical view, despite the late 2025 volatility that dragged Bitcoin down to the high $80,000 after its October peak of $126,000, the market remains structurally bullish.
So what's the signal for recovery?
The immediate signal for recovery toward the $100,000 psychological milestone is the 21-day moving average breakout.
Okay.
The key takeaway here is the expected trend. Institutional buy-the-dip behavior is likely to define the coming cycle. This suggests that while the F&G index will still be a barometer of retail panic, its impact might be moderated by large, patient institutional capital flows that see fear as an opportunity to accumulate.
Essentially dampening the chaos.
Exactly.
The biggest macro context driving all market sentiment stocks in crypto is undeniably the Federal Reserve's posture on liquidity. We've seen a major reversal. The era of quantitative tightening, or the Great Shrink, is officially over.
The Fed has executed a full U-turn on its balance sheet strategy.
And the data confirms this pivot in spectacular fashion. The Fed's balance sheet experienced a weekly shockwave, exploding by over $24 billion in the week ending December 24, 2025. This was the largest weekly surge since the 2023 banking crisis.
That is the definition of aggressive easing.
And it's not a one-off. This confirms a trend of 3 straight weeks of expansion, totaling over $45 billion in less than a month. Total Fed assets now sit at $6.58 trillion, establishing a new, higher floor after 2 years of shrinking the balance sheet.
The reason for this aggressive pivot is that the financial system's plumbing, the banking reserve system, was literally running dry. Overnight funding markets were flashing stress signals, and bank reserves were tightening towards critically low levels.
So to prevent a credit freeze or disruption, the Fed is adding liquidity aggressively.
Right. This isn't just policy easing in name, it's easing in action. The excess reserves that were sucked out over 2 years of QT, they're gone, forcing the Fed to become the market's backstop once again.
That means the supply of money is expanding again. And historically, money supply drives asset prices. So looking ahead to the 2026 projection.
The consensus is that the Fed will likely project monthly Treasury bill purchases of $35 to $55 billion, potentially reaching $550 billion in total purchases in 2026. This pace would likely push the balance sheet back above $7.0 trillion by year-end.
The market implication is immense. It provides a fundamental foundation for future sentiment.
History is clear on this. Liquidity fuels markets. Assets front-run the flow, and volatility and momentum follow. This pivot, marking the decisive end of the Great Shrink, is seen by many analysts as a major macro signal for the next sustained market expansion cycle. Any future greed index readings will be built on this foundation of abundant money supply.
Okay, let's talk about the fine print.
Yeah.
It spent a lot of time highlighting the power of the F&G index and capturing collective emotion. But no tool in finance is perfect.
Not at all.
And relying solely on sentiment can be dangerous. It needs to be treated as a warning system, not some kind of trading algorithm.
One of the most critical warning signs the index can present is the divergence problem. This occurs when the index signals extreme greed based on one input, usually momentum, while other crucial indicators like volume or volatility are simultaneously flashing fear or caution.
Which means the rally is being fueled by a narrow group of assets, not broad participation.
That's it. And market breadth specialists emphasize that narrowing breadth, meaning only a small fraction of stocks reaching new highs combined with strong momentum, is the signature of a late-stage rally.
This dangerous, concentrated pattern famously appeared right before the 1987 crash, the 2000 tech bubble peak, and the 2018 correction. It signals that the easy money has been made and the market is running on fumes.
We saw this divergence very recently in the October 2025 context. Only market momentum was showing extreme strength or extreme greed, while all the other indicators, like the VIX, were flashing fear and uncertainty. This highlighted the divergence warning,
Signaling that the rally was concentrated in a few high flyers like the AI stocks, and that a broad-based top rather than a true capitulation bottom was imminent.
And if you layer other valuation metrics on top of that sentiment divergence, the alarm bells get deafening. Market commentators noted around that time that the Shiller-Cape ratio reached 35.13, the third highest reading in S&P 500 history.
And that matters because the Shiller-Cape ratio tries to smooth out earnings cycles over a decade, giving us a clearer picture of fundamental valuation divorced from short-term greed.
Exactly. When adjusting for long-term profit trends, stocks were just fundamentally expensive. That high valuation level, paired with sentiment flashing a dangerous divergence, is an alarming combination that signals caution, even if the general index looks merely greedy.
A primary inherent limitation of the Fear and Greed Index is also its lack of fundamentals. The index is not based on corporate earnings, economic forecasts, or GDP growth figures.
Right. This means a low score can linger even when corporate earnings are good, or a high score can persist despite clear signals of slowing profits. You always need to look at income statements and macro data alongside the gauge.
This complexity, where emotion actually influences reality, is captured by the concept of reflexivity, which was famously discussed by George Soros. Reflexivity posits that the beliefs and perceptions of market participants, the sentiment, actually influence market fundamentals, creating these dangerous, self-reinforcing feedback loops.
To put that simply, unlike in physics, where observing something doesn't change it, in finance, believing the market is going up actually helps make the market go up because that belief fuels more buying and more positive analysis.
A self-fulfilling prophecy.
In a way, yes. Complex financial system models consistent with reflexivity exhibit what's called low-dimensional chaos. In these systems, reflexive confidence feedback sustains this oscillatory or chaotic motion rather than settling to a stable, fixed point. Market confidence, or sentiment, becomes an active driver of systemic instability, not just a passive measure.
It's the difference between a self-fulfilling prophecy and a hard fact. And if we look at this through the lens of modern quantitative finance, the inefficacy of sentiment as a standalone predictor becomes really clear. Machine learning investigations using sophisticated tools like TextBlob, Vader, and Finbert to analyze news sentiment show that sentiment analysis alone yields weak or even negative predictive power for daily returns.
The models overwhelmingly demonstrate that VIX returns, so objective, market-based measures of implied volatility, consistently emerge as the most influential predictor. Once you account for those objective market-based features, sentiment signals become largely redundant or just noisy in short-term prediction.
So even sophisticated contrarian strategies based solely on VIX spikes and drops fail to produce profitable or risk-adjusted returns after you factor in transaction costs.
Right. It suggests that publicly available volatility information is efficiently priced in, which supports the semi-strong form of the efficient market hypothesis. Sentiment on its own is tough to monetize quickly because everyone sees the number instantly. It's more about measuring the collective psychological health than predicting the price tomorrow.
The final layer of nuance here is understanding whose sentiment we are measuring and how different groups influence the market. This is critical for interpreting the F&G index.
Absolutely. Research on the Chinese A-share market, specifically the CSI 300 stocks between 2015 and 2023, highlights a critical disparity between retail and institutional investors.
And this contrast is staggering. Retail bullishness, so stronger positive sentiment from retail investors, is significantly negatively correlated with stock returns.
Which means?
When the average retail investor gets excited and starts talking about buying, historically, it's a signal to step back. And this adverse effect is even greater for non-state-owned and manufacturing firms, which are often less robust.
And conversely, institutional bullishness has a significant positive association with contemporaneous returns. When the professionals are bullish and they deploy capital, as measured by something like the NAAM index, it correlates with market success.
This positive effect is greater in non-state-owned and heavily polluted firms, which indicates that institutional capital is often able to correctly identify the risk-reward in less transparent sectors.
So this boils down to information asymmetry and market influence. The mechanism test results show that both retail and institutional sentiment affect stock returns, mainly by influencing analyst attention and equity liquidity.
But the key difference in predictive power stems directly from the disparities in their market influence, access to information, and investment goals. Retail investors often represent the uninformed crowd acting on emotion,
while institutions represent the large, informed capital flows that are able to execute sophisticated strategies without being forced out by short-term panic.
So to summarize our journey, we've moved from the careful mathematical construction of the index through these chaotic historical real-world events like the yen-carry trade unwind to the specific liquidity-fueled market signals of today.
Ultimately, the Fear and Greed Index is less of a perfect trading signal and more a powerful reflection of attitudinal research. It's diving into the why, the emotions and perceptions that fuel action, rather than merely measuring the what, which is just pure behavioral research.
That distinction is key for you, the listener. Understanding the F&G index helps you recognize shifts in collective sentiment that impact how you interpret news or price moves or investor behavior. Crucially, it helps you avoid the herd mentality of buying high or selling low when emotional extremes are dictating the price.
Right.
But, as we've stressed, it must always be paired with fundamental and technical analysis, economic data, Fed policy expectations, corporate earnings, and geopolitical developments.
The F&G index is really a measure of vulnerability in an increasingly complex and interconnected system. Look again at the Terra Luna crash in 2022. Sophisticated investors ran first, minimizing their losses because the blockchain allowed pseudonymous transactions to be publicly observable.
They saw the vulnerability building.
They saw it building and acted faster than the crowd could react to the fear index. Less sophisticated investors ran later and suffered larger losses. So, in an environment without a regulatory safety net, public emotional gauges become less about predicting price and more about measuring the system's collective fragility and the speed of response to fear.
So here is the final provocative thought for you to consider. If the market is, at its very base, a reflection of highly complex and reflexive human emotion, a system capable of low-dimensional chaos, what does it mean that sophisticated AI systems, which are fundamentally based on past facts and patterns, struggle to truly recognize and correct a systemic problem that no one has ever seen before?